Decentralized finance, DeFi, has revolutionized the financial landscape by providing open, permissionless, and trustless access to various financial services. Within the DeFi space, one of the most innovative and intriguing concepts is perpetual protocols. These protocols offer perpetual contracts and perpetual swaps, allowing users to trade assets without worrying about expiration dates. In this comprehensive beginner's guide, we will delve deeper into perpetual protocols, understanding how they work, their advantages, risks, and popular platforms in the DeFi space. Perpetual protocols are a type of DeFi trading mechanism that allows users to trade perpetual contracts and perpetual swaps. These contracts are unique because they have no set expiration date. Instead, they offer continuous trading, making them ideal for those seeking a more long-term approach. Perpetual contracts enable traders to speculate on the price movement of an asset without actually owning the asset itself. They work by utilizing a funding rate mechanism that keeps the contract's price in line with the underlying asset's market price. This mechanism ensures that the contract's value remains tethered to the spot market price. On the other hand, perpetual swaps function similarly to futures contracts, but without an expiration date. Traders can go long or short on an asset, allowing them to profit from both rising and falling markets. Perpetual swaps are a popular choice for those who want to hedge their positions or speculate on market movements without owning the underlying asset. To understand how perpetual protocols work, it's crucial to grasp the role of liquidity pools and automated market makers, AMMs. Liquidity pools provide the liquidity needed for trading, and AMMs ensure that trades can be executed at any time without relying on traditional order books. When a trader wants to open a position in a perpetual contract or swap, they must deposit a specific amount of collateral into the protocol. This collateral acts as insurance to cover potential losses in the event of unfavorable price movements. The amount of leverage a trader can use is determined by the collateral they deposit. Once a position is open, traders can monitor their trades and make further adjustments as needed. There is no fixed expiration date for these contracts, allowing traders to hold positions for as long as they desire. This flexibility is one of the key benefits of perpetual protocols. Perpetual protocols offer several advantages that make them attractive to traders and investors. It can be divided into 4 steps. First, offer 24/7 trading. Unlike traditional financial markets that have opening and closing hours, perpetual protocols operate 24/7. This means that traders can respond to market movements instantly, regardless of the time zone they are in. Secondly, it offers no expiration dates. Perpetual contracts and swaps have no fixed expiration dates, allowing traders to hold positions for as long as they wish. This perpetual nature eliminates the need for frequent contract renewal and rollover procedures, saving time and effort. Thirdly, features leverage opportunities. Perpetual protocols often offer leverage, enabling traders to access a larger trading position with a smaller initial investment. Leverage can amplify profits, but it's essential to exercise caution as it also magnifies potential losses. Fourth, it offers hedging possibilities. Traders can use perpetual swaps to hedge their existing positions, reducing their exposure to market volatility. This hedging strategy is particularly useful in uncertain market conditions. While perpetual protocols offer several advantages, it's crucial to be aware of the risks involved, such as 1. High volatility. The cryptocurrency market is known for its high volatility, which can lead to substantial gains but also significant losses. Traders must be prepared for price fluctuations and be diligent in managing their risk. 2. Liquidation risk. Leverage can be a double-edged sword. While it can amplify profits, it also increases the risk of liquidation. If a trader's position moves too much against them, their collateral may be insufficient to cover potential losses, leading to liquidation. 3. Platform risks. DeFi platforms are not immune to security vulnerabilities and smart contract risks. It's essential to choose reputable platforms with a proven track record and undergo security audits. Several popular platforms offer perpetual protocols, each with its unique features and user experience. Some of the well-known platforms include Aave, Synthetix, Perpetual Protocol, and Serum. Before engaging with any platform, it's essential to conduct research and ensure it aligns with your trading goals and risk tolerance. As a beginner, exploring perpetual protocols can be both exciting and challenging. These protocols offer continuous trading, leverage, and hedging opportunities within the dynamic world of decentralized finance. However, it's crucial to approach perpetual protocols with caution and understand the risks involved. Here are some essential tips to keep in mind. Firstly, start small with your investments. Begin with a conservative amount and gradually increase your exposure as you gain experience and confidence in trading. This approach allows you to learn the intricacies of perpetual protocols without putting significant capital at risk. Secondly, continuous education is key. Stay informed about the crypto space, market trends, and various trading strategies. The crypto world is fast-paced and constantly evolving, so continuous learning will help you make well-informed decisions and stay ahead of the game. Thirdly, practice risk management. It's essential to establish clear risk management strategies to protect your capital. Avoid overexposing yourself to high-risk trades, as volatility in the crypto market can lead to substantial losses if not managed properly. Finally, diversify your investments. Diversification is a fundamental principle of investing. Consider spreading your investments across different assets and trading strategies. This helps minimize risk by reducing your reliance on the performance of a single asset or strategy. In the end, I would say perpetual protocols offer exciting opportunities for traders and investors in the DeFi space. However, it's crucial to approach them with a thoughtful and informed mindset. Understand the risks, be prepared to manage them, and take advantage of the benefits of continuous trading, leverage, and hedging. By adopting these tips and diligently managing risks, you can explore the vast potential of perpetual protocols while navigating the ever-evolving world of decentralized finance.